Hello everyone, it's Elliot Gu here with the Free Market Speculator, Smart Bonds, and the Energy Bulletin. Welcome to my Sunday Deep Dive. Now in this weekly video, we take a look at a key chart, trend, or indicator that caught my eye over the past week, and I explain what it means, or what at least I think it means, for markets. Some weeks I really do have to give serious thought as to what's the most important trend I want to cover in this video. But this week, it's crystal clear, and some of you may have already guessed it. The proverbial elephant in the room in the form of that big sell-off in stocks we saw on Friday, June 5th. Now the S&P 500 fell 2.64%, and the NASDAQ 100 was down a whopping 4.77%. However, it wasn't the headline decline in the major US equity indices that really caught my eye. It was some unusual intermarket shifts underway that don't really fit with the prevailing narratives out there about inflation, so-called stagflation, commodities, and Federal Reserve policy. So today, in this week's Sunday Deep Dive, I want to break down exactly what happened on Friday and what I think it means for stocks and bonds going forward. First up, the big move in stocks on Friday was unusual. Based on data since the end of December 1990, so that's more than 35 years ago, Friday's 2.64% sell-off ranks in the 1.74 percentile of all trading days over that period. In other words, out of the last 8,920 trading days, the S&P 500 has only closed down as much or more than it did on Friday on 155 other trading days, so about 1.74% of the time. Meanwhile, the NASDAQ 100's 4.77% shellacking has only happened 74 other times over that same 8,920 trading day period. So that places the move in the even more rarefied 0.8 percentile of all trading days since the end of 1990. And how about that spike in the S&P 500 Volatility Index? That's the index that's probably more commonly known or called the VIX. VIX. Well, the VIX rose from 15.4 at the market close on Thursday, June 4th, jumping all the way to 21.5 on Friday, June 5th. Now that's a jump of almost 40%, or 6.1 points in absolute terms in one trading day. Now on a percentage basis, that near 40% jump in the VIX ranks in the 99.7 percentile of all daily moves. So on only 0.3% of all trading days in my data set, again, 35 plus years, has the VIX risen more on a percentage basis in a single trading day than it did on Friday. That's just 23 days, trading days, out of the last 8,920. So in absolute terms, that 6.1 point rise in the VIX, that actually ranks in the 99.4 percentile. There have only been 54 trading days since the early 1990s where the VIX has experienced an absolute rise, a point rise, larger than it did on Friday. Also remarkable is the fact that VIX spike on Friday represented a nasty case of sort of clear air turbulence, right? Thursday's VIX reading of 15.4, well, that's the 35th percentile of all historical closes. So about 2/3 of the time since 1990, the VIX has actually closed at a higher level than it did on Thursday. So that's a genuine low volatility regime, low fear regime. Now jumping 40% from a regime like that is a very different animal from the same absolute move originating, or percentage move originating from an elevated VIX of say 25 or 30. Most of the really catastrophic VIX spikes we've seen in history, moves in the top 10, like March 2020, the COVID collapse, October 2008, sort of the heart of the great financial crisis, and August 2011, when US debt was downgraded, arrived. All these big spikes in the VIX in those times arrived when volatility was already elevated. So VIX spiked, in some cases more in percentage terms or absolute terms than it did on Friday, but it also started at a much higher level. So Friday's spike launched from calm water. That's very, very unusual. Bottom line, we simply can't ignore a market move or a spike like that in the VIX. And again, the VIX is basically the stock market's fear index. that's that genuinely unusual. We just can't ignore it. We can't afford to. Now, as many of you may be aware, the catalyst, or the most commonly cited catalyst anyway, for Friday's big sell-off was a far stronger than expected employment situation report, jobs report from BLS, the Bureau of Labor Statistics, which showed the U.S. added 172,000 non-farm payrolls in the month of May, this May, 2026. Now that was about double the sort of 85 to 90,000 job growth expected by consensus on Wall Street, consensus of economists on Wall Street. Now on top of that, and I think this is actually even more important, BLS announced an additional 93,000 payroll upward revisions to the prior 2 months' reports. So those were the reports covering the months of March and April 2026. So not only did we beat expectations for May, but we also saw a huge upward revision. The first major revision really of that magnitude in a long while for the months of March and April. Now I'll have more to say about that in an update I plan to send out in the next few days on the Free Market Speculator website. There's just no way I can cover all that ground in today's video without turning this into a 2-hour long economics lecture, which I'm sure isn't really great on Sunday. For now, suffice it to say that I generally agree with the consensus take. Okay, this was a strong report, and it was a meaningful positive surprise for the labor market. I also think it's tough to argue that that strong BLS number was not the catalyst for Friday's selling pressure in stocks. I've seen a few people try to do that, but the timing is just too perfect. So around 8:25 a.m. Eastern time, right? S&P 500 front month futures were trading at around 75.50, right? The jobs number dropped at 8:30 a.m. and the futures began to weaken pretty much almost immediately within just a couple of minutes. Now by 10 a.m., which is 90 minutes after the jobs release and a half hour after the cash stock market opened for trading, it's a kind of time period, that first half hour, where you see the real reaction to an economic report like that. In that 90-minute period, the S&P 500 futures were down about 0.5% from that 8:25 a.m. level. Now by noon Eastern time, we were down north of 1.3%, and the waves of selling just continued and continued right to the closing bell at 4 p.m. Eastern. So let's back up and think about that. What does this all mean, right? A stronger labor market, a solid U.S. economy, right? And resurgent inflation means rising probability of Fed rate hikes. Now, while Kevin Warsh, who's the Fed's new chair, may want to cut rates, it might be tough for him to get the votes on the Fed's Federal Open Market Committee, which is the rate-setting committee at the Fed, to push through rate cuts given the strong economic data we've seen. And indeed, we did see significant repricing in the Fed funds futures market. As I said, Kevin Warsh, who was appointed as the new Fed chair by President Trump early this year, he was officially confirmed back in mid-May and went on to replace Jerome Powell, right? Now his first meeting as chair will be this month. It's only about 10 days from now, or exactly 10 days from now actually, on June 17th. Now the Fed at that meeting is widely expected to hold steady on rates at the June meeting. There's been very little change in probabilities even after Friday's blowout report. However, let's look at the Fed's final meeting this year, which happens to be on December 9th of 2026. And I also want to take a look at Fed fund probabilities for their meeting about a year from now, on June 9th, 2027. Again, about a year from now. Now, a week ago, right, this is a week before the jobs number came out, Fed funds futures market saw a 54.7%, so more than 50-50 chance the Fed was going to be on hold, no changes to rates up or down, through its final meeting this year, again on December 9th. They did price in about a 36% probability, a little better than 1 in 3, that the Fed hiked once by the end of this year. And by that I mean 25 basis points. And an 8% chance they hiked twice by 50 basis points. Now, it was a week ago. As of the close on Friday, however, markets had slashed the probability the Fed remains on hold through year end by roughly half, to just 28.9%. The market's new base case is a single 25 basis point hike, which carries a 42.8% probability, the highest of any specific outcome. And the market now sees almost a 1 in 4 shot. It's actually a 22.3% probability. To be exact, the Fed hikes by a full 50 basis points. So that's a full 0.5% by December 9th. Now the probability of more than 2 hikes, right? So more than 50 basis points of tightening now sits at a little over 5%. Still very small, right? But quadruple what it was a week earlier. Now let's zoom out to the middle of next year, to the Fed's scheduled meeting on June 9th, 2027. The probabilities for that meeting are on your screen. So a week ago, the market was essentially pricing in one single 25 basis point hike by next June, a year from now. A little over 40% probability the Fed hiked once over the next year, and a 35.6% chance they held rates steady. The probability of 50 basis points of hikes or more, that was a little less than 19%. So as of Friday's close, a week later, right, the market severely marked down the probability the Fed holds rates steady over the next year to just 12.8%. So the hold is kind of off the table. The market also kicked down the chance of a single hike to just over 30%. The consensus is now leaning toward 2 hikes, 50 basis points over the next year, 31.4% probability, or even more than 50 basis points of hikes with a probability of just under 25%. Now that's a pretty dramatic change in expectations around Fed policy through this year and through the middle of next year. And it fits pretty well with the inflationary interpretation of the May jobs release I just outlined. Now it also supports the view a hawkish turn at the Fed was behind Friday's bloodbath in stocks, catalyzed by that jobs report. Sure enough, the media was replete with stories about sticky inflation, a brewing conflict between the Fed turning more hawkish and the White House pushing for lower rates, a potential clash between hawkish members of the FOMC at the Fed and their own new chair, Kevin Warsh. And the usual discussions, which we see all the time these days, about a 1970s style stagflation episode and an equity, consumer, and economy crushing higher for longer rates environment. Yet, the bond market told a very different story, right? On Friday, the yield on the 30-year Treasury rose just 2.1 basis points. Now that's 0.021%. And it closed at 4.999%, so just under 5%. Now, over the entire period since 1990, since the end of 1990, right? A 2.1 basis point rise in the 30-year yield, that ranks in the 68.9 percentile of all daily moves in 30-year Treasury yields. That means that on just under 1/3 of all trading days since 1990, 31.1% of all trading days over the past 35 plus years to be exact, 30-year yields rose 2.1 basis points or more. So as much as they did on Friday or more. For the entire 35-year sample period, the standard deviation of one-day changes in the 30-year Treasury yield is right around 5.2 basis points. So Friday's 2.1 basis point rise, it's only a little over a 0.4 standard deviation move. That's just noise. So while equities got smoked, okay, that was a 2.36 standard deviation sell-off for the S&P 500 and 2.9% for the NASDAQ 100. While stocks got killed, the long bond barely budged. So let's put this situation into perspective. Over the past 35 plus years, the S&P 500 has declined 2% or more on 318 different trading days, including Friday. And about 75% of the time, when the S&P 500 declines 2% or more, the 30-year Treasury yield actually falls, right? Outright falls. Now this is because for most of the last 35 years, Treasury bonds have been viewed as a safe haven against equity market storms. So when investors are worried about the stock market and the economy, they tend to buy bonds and yields accordingly fall. Price goes up, yield goes down. Now think about the big Treasury bond bull market back in 2008 amid the financial crisis and Great Recession of that era. Okay? Big bull market in bonds, big bear market in stocks. Yields down, stocks prices down. Now I'll grant you that the 2008 experience, or the experience really of most of the past 35 years, is not relevant to the current situation. At least not entirely, right? It's a matter of regimes. For much of the past 35 years, markets haven't been overly worried about inflation. So bonds will naturally behave differently in an inflationary regime like today compared to a disinflationary or an outright deflationary regime like we saw, for example, again in 2008. Yet I want you to look at this. There have only been 80 trading days in the past 35 years, right? Same period, when the S&P 500 sold off more than 2% and 30-year Treasury yields actually rose. This chart shows the distribution of those returns over time. Now, I've divided these 80 trading days into quartile buckets, right? Quartile 1 is what I would describe as a very muted rise in 30-year yields on bad days for the stock market. That's a rise of less than 1.7 basis points. Now, those are the dark gray columns on this chart. Quartile 2 represents yield pops of 1.7 basis points up to 4.6 basis points, represented by the blue columns, right? Quartile 3 is 4.6 to 7.8 basis points in orange, and more than 7.8 basis points, that's quartile 4, Q4, in red. Those are big spikes in yields following amid a down day for stocks, a severe down day for stocks. So Friday's move, which I've labeled in gold here, was a quartile 2 move in terms of the yield increase following a big down day for stocks. So it was actually at the low end of quartile 2 and just above the high end of that quartile 1 bucket. Really pretty pedestrian from any historical standpoint. However, what really might surprise you is not if the yield goes up or down, but when these 80 trading days happened. When did 30-year Treasury yields rise when the stock market got crushed? When historically? Perhaps, for example, you thought it was only a recent phenomenon, right? Something that happened in 2022 amid the regime change from a disinflationary, deflationary regime to an inflationary regime. And certainly there have been some days when both bonds and stocks got slammed since 2020. Severe bond weakness, quartile 4 spike in yields in the context of a falling stock market, well, that happened twice in 2022. And we actually saw 3 quartile 4 red bars in early 2020 amid the absolute chaos of the COVID lockdown recession, the sell everything moments. However, what some viewers may find even more surprising, right, is that some of the most severe 30-year yield spikes in history that accompanied stock market weakness happened way back in the late 1990s. To be specific, there were 4 big 30-year yield spikes between 1996 and 1999, and 2 of the largest in the entire history I'm showing you here happened in 96. And guess what? In response to some dramatically better than expected payrolls data from BLS back then, 30 years ago. Sound familiar? You can also see a significant grouping of quartile 3, quartile 2, and even quartile 1 yield spikes there on the left-hand side of my chart, which shows the period from the mid and late 1990s. Suffice it to say that the late 90s were a pretty great time to be invested in both stocks and treasury bonds. Now, many of you are probably familiar with the late 90s boom in equities. However, treasuries were no slouch either. With yields on the 30-year range-bound, the carry on long-term government bonds, basically that's just a fancy word that means accumulated interest payments, they generated some high single-digit annualized returns from long-term treasury bonds in that era. Regardless, Friday's move in yields was pretty much a non-event, particularly given the scale of the decline in the S&P 500. So let me ask you this. If this is a genuine inflation and higher for longer potential hike shock, why did bonds barely budge on Friday? So before I give you my answer to that question, let's move on and dig in a little bit deeper. I've written and spoken before about the ICE, Bank of America High Yield Options Adjusted Spread, OAS spread. Basically, it's a measure of how much high-yield corporate borrowers, what we used to call junk borrowers, companies with less than perfect credit, if you will, how much do they pay to borrow money relative to treasuries, U.S. government bonds of equivalent duration, time to maturity. So when markets are worried about the economy, or indeed the ability of high-yield borrowers to service their debt with yields on the rise, right? You'd expect high-yield credit spreads to rise. Really, they tend to spike higher in such environments. The market would demand a higher rate of interest, better returns from shaky borrowers to compensate for increased risks when the economy weakens or there are concerns that rising rates will impact the ability of these companies to repay, right? Logical. Rising equity volatility, fear in the stock market, that VIX spike, should, right, equal rising high yield spreads, all things equal. Indeed, since 1997, the S&P 500 Volatility Index, again the VIX, it has jumped 5 points or more on 87 individual trading days. And on 90% of those days, the ICE Bank of America High Yield Options Adjusted Spread, that's a mouthful, has risen by an average of 28 basis points, okay? And a median of 21 basis points. Seems pretty logical, right? Well, on Friday, the ICE Bank of America High Yield Bond Spread actually fell by 1 basis point to just 2.74%. That's the 3.9 percentile for this spread on an absolute basis, consisting of all closes over the past 29 years. It's such a rare event, let me just go ahead and show you a table. There are only 9 occurrences here in almost 30 years, times when the VIX spiked and credit spreads fell. And what did the stock market do on average after this signal? Well, plus 1% in a week, plus 2.4% in a month, plus 6.9% in a quarter, plus 12.4% in 6 months. All meaningfully above the unconditional equivalents of 0.34%, plus 1.26%, plus 3.15%, and plus 5.69%, respectively. The signal has historically added value at every horizon, even using the more conservative mean. If we look at the median, which will reduce the impact of the 2008 Great Financial Crisis and 2022 outlier events, the returns jump to higher levels, 2.3% over a week, 15.3% over 6 months. Pretty impressive, really. So before I do a deeper dive into the equity stock market side of the equation, let's address this. This is something I wrote about last week in Smart Bonds and discussed in my Sunday Deep Dive a couple weeks ago on May 17th in a video titled Beijing Disappointment and the Great Yield Ramp. I'll throw a link to that below. Basically, this represents the net position of leveraged fund speculators in the 30-year Treasury and 30-year Ultra Treasury futures. Specifically, this shows the net loss in millions of United States dollars for speculators in the long bond for every 1 basis point decline in 30-year Treasury yields. Now again, recall that a decline in Treasury yields implies a rally in Treasury prices. So the net short leverage fund position in Treasuries today represents a record-sized bet on higher rates. So here's the thing. Friday was almost a dream setup for the long bond Treasury shorts, right? We had a very hot jobs number implying a need for the Fed to hike rates. We had a big repricing in Fed fund futures, pricing in rate hikes as I outlined earlier. The stock market got crushed, and the good old narrative about sticky inflation, higher for longer rates and a hawkish Fed was all over the media comparing it to 2022, right? Yet, bonds yawned, and 30-year yields barely budged. Indeed, yields remain down about 20 basis points from where they were at the recent peak in mid-May. Now, what happens when you have theoretically very bearish news and bonds don't react to it? And what happens when everyone is already bearish the long bond? All those speculators. You get the perfect fundamental setup, right, for them to win money, right, to be right, and bonds still didn't cooperate. They just traded sideways. In my view, the consensus is probably right about the jobs number being genuinely strong, but probably very, very wrong about what it implies for the long end of the bond market right now, for that 30-year Treasury bond, given the positioning structure we see underneath that market. I think there's limited downside risk in prices for 30-year bonds, limited upside for yields here. It's a classic case of market exhaustion, with everyone already positioned for higher rates, higher yields, and the consensus so overwhelmingly bearish. The bad news is already priced in the market, and there just aren't that many sellers on the sidelines to push bonds lower from here. So back to equities. As I said, the broader market got smoked, but it was pretty selective indeed. Now here's a look at the performance of the S&P 500, the S&P 500 equal weight index, which weights all stocks in the S&P 500 the same. The Russell 1000 growth index, that's a large cap index of stocks, growth stocks. The Russell 1000 value index, and all 11 S&P 500 sector spider ETFs. These are publicly traded ETFs that track individual economic sector indices in the S&P. There are 11 of them. So I'm showing you what they returned on Friday, June 5th. Now I've labeled the S&P 500's 2.64% decline as an orange bar here, right? So all the sectors and indices above that orange line, now I've boxed them in with that black box there, right? That heavy black box. All those indices and sector ETFs outperformed the S&P 500 on Friday. So the list includes 5 of the 11 S&P 500 economic sectors that actually closed higher on Friday. So broader market was down. There are 11 S&P economic sectors and 5 closed higher on Friday, not lower. So this happened when the market got crushed, the broader market got crushed. Now some of these winners aren't a huge surprise, I suppose. Consumer staples, healthcare and utilities, for example, they're all more defensive, low beta groups, right? That tend to catch a bid when the stock market sells off, at least in the short run. However, how about financials? Up on Friday, with the broader market getting crushed. Not pictured here, but even the KBW Regional Banking Index, now that's an index of sort of small and mid-sized US banks, that was up about a 1/4 percentage point on Friday, with stocks down big. Even industrials, down just a little over 1.1%, less than half the decline in the S&P 500. Industrials, financials, regional banks, these are all cyclical groups that tend to do well and outperform the S&P 500 when the US economy is strong and credit markets are robust. In short, Friday's big sell-off was all about tech. The Select Sector Spider ETF for technology, that trades under the symbol XLK, well, it plummeted 6.7% in Friday's session. I guess I won't mention that unrounded decline there that you can see on the chart on a Sunday, right? The Russell 1000 Growth Index, a broad index of large cap growth stocks, also dominated by tech, was down 3.27% on Friday, underperforming the S&P 500. Other than that, all of these sector indices and other groups on my chart actually beat the S&P 500. And look at the Spider Consumer Discretionary ETF there, down 2.05%. That's almost as much as the S&P 500 on Friday. But the 2 largest holdings in this ETF are Amazon.com and Tesla. Now those are both names more closely associated with big tech than what we traditionally think of as consumer discretionary, right? Amazon was down over 3% on Friday, and Tesla slumped almost 7%, 6.56%. The next 3 largest holdings after those 2 in the Consumer Discretionary Index are Home Depot, home improvement store, TJX Companies, that's the firm behind TJ Maxx, and McDonald's. You all know what that is. Those 3 stocks, and I would argue those are all names that many investors would associate more closely with the term consumer discretionary, right? Probably at least more so than Tesla. They were up 0.27%, 1.31%, and 2.61% respectively. So I'd argue that even within consumer discretionary, the decline was all about tech on Friday. Some of these dispersions are truly eye-popping. First up, consider the cross-sectional standard deviation of the 11 S&P 500 spider ETFs. Basically what that means is that on any given trading day, we can compute the returns for all 11 sectors individually. I did this for every trading day in the data set, basically since 1999 for most of these sector ETFs. I then calculated the mean, the average, of those 11 daily returns and the standard deviation around that average. The wider the standard deviation, the bigger the gaps in performance between different sectors on a particular trading day. Now on Friday, that standard deviation was 2.3 percentage points. The average for the whole data set is about 0.77 percentage points. So on Friday, the gaps in sector performance was about 3 times wider than the long-term average. That's the 98.4 percentile for the entire sample since 1999. That means, right, that only on 1.6% of all trading days since 1999 has the sector cross dispersion been greater. And what I'm throwing up on your screen right now is a little more of a zoomed in view. So this shows the z-score of the cross-sectional dispersion on a rolling one-year basis. So basically it tells us how unusual the sector dispersion was on a particular day relative to the recent, that's the trailing one-year history. Now Friday's session had a z-score of 4.74 standard deviations above the one-year average. Now as you can see, such readings are very unusual. We saw it at the height of the COVID lockdown panic, around the 2020 and 2024 presidential elections, when the so-called yen carry trade blew up in the summer of 2024, and of course the April 2025 tariff panic lows. Oftentimes these spikes actually occur at market lows, not peaks. Now in 2022's bear market, we saw some elevated dispersion, but no days quite like Friday. However, here's what I think is even more telling. I decided to examine only days when the S&P 500 was down more than 2% since the late 1990s. So this table lists all 11 S&P economic sectors. There have been 80 down days of 2% or more for the overall S&P 500 since the late 90s. And the first column there shows the median return for each sector in my table on those 80 sell-off trading days, right? The next column shows Friday's return for each sector, followed by a column showing the difference between the median return on down days and Friday's result. And the final column shows where Friday's return ranks compared to the other 80 trading days since the late 90s, when again, the S&P 500 was down 2% or more on a single trading day. There are some genuinely shocking results here. Now, technology's performance on Friday was almost 3% worse than the median return on 2% plus down days through history. It's only performed worse relative to that median 6% of the time since the late 90s. Dismal. Now, every other sector, 10 of the 11 sectors on my table here, actually outperformed the median return on those same 80 big down days for the stock market. 3 sectors, industrials, financials, and consumer staples, have actually never performed better in 27 years of financial history than they did on Friday, June 5th, 2026, compared to the broader market, compared to the broader market on big down days for the S&P 500. Healthcare, real estate, communication services, and utilities also should get honorable mention here, since they all ranked well up in the mid to high 90s percentile range. Pretty incredible, right? And these aren't all just defensive sectors, right? Financials, industrials, they're cyclicals. Significant sensitivity to the health of the economy. In a recent Sunday Deep Dive, I presented evidence that the rate sensitivity of utilities and real estate is actually exaggerated by the financial media. However, on Friday, with all the talk of a hawkish Fed, you might have expected these groups to take at least a little bit of a hit. They did not. In fact, they both rose in absolute terms and performed in the 100th and 99th percentile of all 2% down days for the S&P 500 since the late 90s. In short, I believe the stock and bond markets are trying to give us a very specific message. The US economy is in fine shape. Growth is actually accelerating, and the Fed may indeed push through a couple of rate hikes over the next year. However, the bond market's yawn on Friday, coupled with that massive speculative short position in the 30-year treasuries, tells us two things. First, the rate hikes were already priced into long-term treasuries. And second, the bear steepening trade, yields rise across the yield curve, but fastest at the long end, that the speculators have been betting heavily on, it just isn't panning out. The risk of a 2022-style tightening campaign that slams both the stock and bond market substantially simultaneously is actually quite low, and the market doesn't believe a few rate hikes is going to derail the economy. Indeed, the stock market setup bears more than a passing resemblance to the late 90s. The economy was strong back then too. There was a technological revolution underway. And the Fed chair, which was then Alan Greenspan, now of course Kevin Warsh, they appear more likely to pursue modest adjustments to rates up and down over time in response to incoming economic data than to embark on major tightening and loosening campaigns. Bonds and stocks performed well, very well in the late 90s, though there were some nasty corrections, particularly in stocks, and shakeouts along the way. At this point, you might be wondering, what about the broader stock market this summer? What does Friday's shellacking mean? Well, let me give you two quick stats to frame how I'm looking at it right now. First, I examined data since the early 1990s, 35 plus years, for the S&P 500 and the NASDAQ 100, right? Looking for occasions where these indices were 5 days or less away from logging a 52-week high. In this case, it was also all-time highs for both those indices, and saw a one-day decline of 2 standard deviations or more based on the full data average. So there are 40 trading days that match that description for the S&P 500. Basically a big decline from near an all-time high, including Friday, and there are 44 days for the NASDAQ 100. So here are the median forward returns compared to the full sample average. As you can see, median returns for the NASDAQ 100 after a 2 standard deviation one-day sell-off that starts from near a 52-week high, well, they're actually higher than normal. Out to about 1 month forward. 3 and 6 months out from these signals, there's a slight underperformance, but it's not really significant. For the S&P 500, 2 standard deviation declines starting from near 52-week highs tend to produce superior returns out to about 3 months, and returns more or less in line with the long-term median out to 6 months. The message? One-day crashes when the market is near its highs are often buying opportunities, and they are not signals of major short to intermediate term market weakness. Now, Friday was also what technicians call a bearish engulfing pattern on the weekly chart for the S&P 500 technology ETF. So here's a 3-year weekly chart of that ETF under the symbol XLK, which comes to you courtesy of stockcharts.com. So you can see what I'm talking about here on this chart. A bearish engulfing pattern describes a situation where the current week's bar, or candle in this case, totally swallows the prior week's bar. So look at this chart. The week ending June 5th, that's last week, opened at 192.32. So that was above the prior week's close of 191.02. It reached an intraday high of 198.73 last week. That was a marginal new all-time high for XLK. XLK then reversed to close at 180.30. That was below the prior week's open of 183.20. So the current week's body of the candle there completely swallows the prior week's body. Further, XLK was comfortably above its 10-week simple moving average, which confirms it was in an uptrend, which is typically a requirement of a proper bearish engulfing pattern. So this one is actually textbook, a textbook bearish engulfing pattern on a weekly chart, which is considered more meaningful. Now there have been 57 examples since the late 90s where XLK, that technology ETF, had a bearish engulfing pattern. And this table presents the forward returns on an average, mean, and a median basis. The message here, over holding periods of 1 and 2 weeks, returns are a bit below the full cycle average. So that suggests some near-term volatility, and that's hardly a shocker given how much the XLK, how much tech has moved in just the past couple of months. Just a big rally there. However, beyond the short term, returns are in line with or slightly better than long-term norms. Bottom line for stocks. While I do see the potential for some moderation in returns from the tech sector this summer, even a modest correction, what we saw Friday isn't really the fingerprint of a bull market top. It was more about rotation into sectors outside tech that have been lagging but are beneficiaries of stronger economic growth. Exactly what was implied by the employment report, the jobs number from BLS we talked about earlier that came out last week. So we've covered a ton of ground in this week's Sunday Deep Dive. And the more I dug into the data, the more unusual Friday's session looked for both bonds and stocks. It really just doesn't fit with the narrative being pushed this weekend. However, I actually have more I want to show you, including some additional cross-asset and intermarket relationships that evoke the late 1990s. I also think we're seeing increased evidence why the 1970s stagflation playbook that so many investors are using, it's behind, I think, the big speculative short position in the 30-year futures, why it's just wrong this cycle. Now, I'll give you a hint. The US has huge, enormous energy and commodity advantages it just didn't have in 1974. And not only in absolute terms, but also relative to the other major economies around the world, like Europe, Asia, even China and India, right? Major emerging markets like that. So I'll have to leave some of those topics for a future Sunday Deep Dive. Feel free to comment below if you're interested in those topics or not, or have another interest. And please, if you wouldn't mind, if you did enjoy this video, drop me a like, it really helps out. Also, for readers who want to understand exactly how we're positioned in the bond, credit, and preferred stock markets right now, so our sister publication, Smart Bonds, is now open for 60-day free trials. So I'll leave the link below for that. Despite all the talk of bad returns in the bond market, our baseline model portfolio in Smart Bonds is actually up 7.31% over the past 52 weeks, besting our benchmark by about 2.3%. And we're also still offering free 30-day trials to the Free Market Speculator and Energy Bulletin publications. The paid tier for both is one subscription only for both publications. And I'll leave the link below for that as well. Thanks for listening. I'll be back next week with a new Sunday Deep Dive, and I sure do hope you enjoyed this one.